In one of my first few videos, I've given an insight into what mutual funds are. Let me give a quick recap regarding them. Not everyone can invest in the market. There are several reasons why investing directly in the stock market isn't everyone's cup of tea. I tried my hand at it long back and it turned out to be quite stressful. To invest in the market, you need to have time, patience, money, a lot of money, and knowledge about the various companies, their financials, and other parameters that judge your investing pattern. Since I have no time or patience, I opted for mutual funds. So how does a mutual fund work? Just like me, there are several others who can contribute a small amount of money, and this is collected by an asset management company and invested in the stock market. To explain this, let me take one equity fund and one debt fund as an example to show how they work. Before that, let me give you a quick summary of each of the type of funds. The advantage of mutual funds are that you have so many choices. Equity funds have always the highest returns in the long term. Debt funds have got tax advantages and regular income. Liquid funds give you access to small amounts of cash in the short term. Hybrid schemes are a combination of equity and debt funds. Fixed maturity funds are similar to debt but more closely related to fixed deposits and give you a slightly higher rate of return compared to a bank FD. Exchange traded funds allow you to invest in commodities like gold, and you need not buy 10 grams of gold at a time, and some mutual fund plans even allow you to invest as little as Rs 500 to buy electronic gold. Fund of funds invests in a collection of mutual funds. For example, if you invest Rs 1000 into a mutual fund which is a fund of funds, your money will be invested in equity funds, debt funds, exchange traded funds, and other funds. First, let me explain what a debt fund is, or rather let me tell you something about debt first before I get into debt funds. Debt instruments are quite complicated. Did you know that recently the Ministry of Finance in India said that there is an urgent need to develop a debt market in India? Believe it or not, it is easier to raise money in the form of debt outside India than trying to raise debt within India. Raising money in the form of debt from sources outside the country is referred to as external commercial borrowings. Companies are forced to borrow money from institutions like Industrial Finance Corporation of India or Industrial Credit and Investment Corporation of India rather than actually raise debt via the public. Borrowing from Industrial Finance Corporation of India would mean companies have to pay upwards of 12% as the rate of interest. However, borrowing from the public means giving a small rate of interest which is slightly over the average fixed deposit, that is around 9% per annum. Debt mutual funds invest in debentures or government bonds. I am taking the example of SBI Magnum Gilt Fund. Gilt funds mean you are investing in Government of India bonds. These could be either the state or the central government bonds or a mix of both. Gilt funds carry a small amount of interest rate risk. That is, you could earn a little less than you expected. But nonetheless, this is compensated by the fact that these investments carry a zero default risk. That is, you can't lose your money at all. But let me go back to interest rate risk here. Just how much do you lose on your interest rates? So I went to the Bloomberg website to find the answer. In the last 5 years, the interest yield has varied between 7% to 8.5%. This might seem a lot, but a sensible investor knows never to put all his investments in one sector, and diversification will reduce the interest rate risk or any other risk in fact. Also remember, the interest rate I mentioned is for the government bond which has a 10-year maturity. So there is a chance it can give you a greater yield, maybe over 10%. Typically, if you want to buy government securities, you need to spend a minimum of 10,000 and buy additional bonds in multiples of 10,000. So if I buy 10 bonds, I should invest 1 lakh rupees. But in mutual funds, you need to invest first Rs 5,000 and additional investments can only be Rs 1,000.